Your money, your stories, your freedom. The Peter Schiff Show.
Welcome, everybody. This is Peter Schiff here at SchiffRadio.com. A lot to talk about today. The market's really melting down around the world. It really is deja vu for 2008, September, October-ish, where everything seems to be in free fall, and people are piling into the U.S. dollar today and U.S. Treasuries. In fact, the Dow Jones is down now about 330 points. It was down 280 points in the last hour and a half yesterday after Ben Bernanke came out and announced Operation Twist. So that's a huge drop in the Dow in, under 3 hours of trading. Worldwide stock markets are falling in sympathy with the U.S. The dollar, as I said, is rising very sharply across the board, particularly against economically sensitive emerging market currencies, commodity currencies, all getting whacked. But the dollar pretty much up across the board, maybe with a lone exception to Japanese yen. The dollar is actually down against the Japanese yen. In fact, the yen is really on fire. I wonder if the Bank of Japan is going to come in overnight with intervention. We are close to a record high in the yen versus the dollar today, which means we're probably at a record high in the yen versus the euro. I haven't checked those crosses, but the yen is actually the only safe haven today. Even gold is losing its luster for the day. Gold is off. I'm looking at the GLD now, the ETF, which is off the equivalent of about $60. Gold dropped $20 on that ETF right after Bernanke's statement. So that's about an $80 move in the price of gold based on the Fed announcement. Silver also down big today. The SLV down close to $3 an ounce, trading below 36. Oil also getting clobbered. Crude down about $4.50 right now, close to $81 a barrel. Copper, all of the industrial metals getting hit hard. Not only is it that we have the news out of the U.S., and, of course, not only was it the fact that the Fed, and I'm going to talk about Operation Twist and why that's going to put the squeeze on the economy. It's actually going to backfire on the Fed. But also the Fed basically had some very, gloomy ways of describing the U.S. economy, although not totally gloomy enough. But I guess that scared the markets. But also overnight, we got weaker than expected data out of China. Their manufacturing, the PMI, slipped a little bit down to 49.5 from 49.9. And that's got the world worrying about a slowdown in the Chinese economy. But, the interesting thing is that the export sector is slowing down, but the domestic economy continues to grow. I'm reading from a news story here that's talking about how the export sector is looking risky, but the domestic economy is improving. And the reality is the domestic economy would be improving much more if China let the currency rise. In fact, also, even though we got weaker than expected economic news in China, the inflation numbers actually inched up and got worse. So a double whammy of higher inflation. And, China is trying to, in Keynesian fashion, put the brakes on its to fight inflation by putting the brakes on the economy, by trying to slow down growth. That's not going to work. They need to slow down the growth of the money supply, not the growth of the economy. They need to depeg from the U.S. dollar. And that will kill inflation dead in its tracks in China. In fact, it'll send consumer prices falling, which will send domestic demand exploding. And China will have the best of all worlds, enormous economic growth and falling consumer prices. If only the Chinese could figure this out in time. But for now, they're continuing to try to sell products to American consumers who are obviously too broke to buy them. In fact, this Operation Twist is an attempt on the part of the Federal Reserve to engineer a reduction in interest rates so that Americans can go back to a familiar pattern to live beyond their means with another round of mortgage refinancing, because there hasn't been a lot of mortgage refinancing lately, and the Fed is trying to drive that. We've had plunging long-term interest rates in the last 2 days. The yield on the 10-year U.S. Treasury is down to 1.77. That's the lowest it's been since, I guess, the 1940s when we were, on a gold standard. And the 30-year is down to 2.864. Now, that isn't a record low. We got down to 2.5 in the depths of the financial crisis in 2008. So it looks like we're headed down there. The Fed is trying to engineer another wave of mortgage refinancing. But, this time it's going to really squeeze the banking sector because in prior waves of refinancings, you had the long rate coming down and the short rate. So even though the banks were able to refinance and take a lower yield on their paper, they got a lower yield themselves. But that's not going to happen this time. So all the money that homeowners gain from a lower mortgage is going to be lost dollar for dollar to the financial sector or anybody on the other side of those loans. It's not money for free. If the government can bring down mortgage payments, it brings down interest income for the people who own the mortgages. So it isn't a net benefit to the economy, and it's going to crush the banks. That's one of the reasons that if you look at these banks, they are leading this market down. They're getting clobbered. Look at Citigroup at a new 52-week low, Goldman Sachs, new 52-week low, Morgan Stanley, 52-week low, J.P. Morgan, and these stocks are just collapsing through their 52-week lows. Bank of America isn't at a 52-week low yet because it still had that big Buffett rally, but it's almost there. It's almost below where it was before Warren Buffett came in and injected a bunch of capital. Remember, as a result of the Warren Buffett infusion, B of A shares rose all the way up to $8.80. We're now back down to $6.18 and falling fast. So that sector is going to be hurt. And, of course, this is the real paradox. A lot of politicians, and, when I testified up there in front of Congress, people were asking about credit. What about credit for businesses? Small businesses need to get credit. This policy, Operation Twist, is actually going to make it harder for small businesses to get credit. Now, why is that? Well, because this is going to hurt the banks. This is going to hit the banks right in the pocketbook. It's going to hurt their bottom line. It's going to diminish the capital that the banks have to make loans. Because instead they've got to refinance all these mortgages, and they're going to lose all this revenue. And, of course, one of the ways the banks, the government wants to facilitate this is they want Freddie and Fannie, to guarantee these mortgages, even if they are 125% of the value of the properties. Because a lot of people are not in a position to refinance because they simply don't have enough equity in their properties. But is it going to help the economy? That's another note. Is it going to help the economy? Let's say Americans are able to do another round of refinancing and they can cut their mortgage payment by $50 a month or $100 a month, something like that. Is that going to help the economy? No, it's not going to help the economy. I mean, yes, it might help temporarily the people who save the money, but based on the banking sector that lose the money and the insurance companies and the pension funds, is going to be a net drain on the economy. And, of course, what are Americans going to do with the extra money? They're going to spend it. They're going to spend it on imports. It's going to drive up the trade deficit. There's no economic growth there. We don't need more consumer spending, and we don't need lower interest rates. Anyway, I'll be back. We're going to continue this discussion here on the Peter Schiff Show at SchiffRadio.com.
The Peter Schiff Show. To President Obama, Secretary Geithner, Madam Pelosi, and all of the socialist econ professors across America, we're sorry. We're sorry. Peter Schiff is back on the air.
Welcome back. Peter Schiff here, and we are talking about the stock market and the Fed and how they're putting a squeeze on the economy with this Operation Twist. But, the whole theory behind what the Fed is trying to do is that the reason the U.S. economy is in trouble is because long-term interest rates are just not low enough. Even though they're pretty much the lowest they've ever been, the Fed is convinced that if they could just get them a little bit lower, that'll do the trick. They don't understand that low rates are part of the problem. They are not part of the solution. So this is not going to work. What the Fed is doing isn't going to work. I don't even think maybe the Fed doesn't even appreciate how screwed up they've got this economy. What I think is going to happen now is we're really going to put some downward pressure. Remember, I talked about my belief that the Dow Jones was going to break through to about 10,000, that we were putting in this rising wedge pattern. Well, technically today we've broken through the downside of the wedge, and so it now does project quite a bit lower. I do think we end up taking out the low on the Dow, which was around 10,600, going down to around 10,000 even. By that point, I think the Fed is going to panic. And I think they're going to do the only thing that they know, which is give the market what it wants, more heroin. Give the drug addicts more of what they want, more cheap money in the terms of, okay, we surrender, we're getting the helicopters out, we're going to drop the money. Because that's the only thing that's going to work. Of course, it's not going to work, but that's what the Fed is going to do. Because if they don't do that, then the banks are going to fail. All those banks that were bailed out are going to fail. I mean, there's just no way around it. And then what are they going to do? Does the government want another TARP? I don't know. So the only way to avoid another round of government bailouts is going to be to start printing money. That's all they can do. And, the interesting thing, you hear all the people I'm listening on on CNBC talking about how if we could just get consumers to refinance, they'd have more money to spend. Yeah, if that would work, if just giving consumers money to spend was the answer, then just give it to them. Why doesn't the Fed just mail everybody a check? Just send everybody 10 grand. Send everybody 100 grand. Then they'd have plenty of money to spend. See, it doesn't work. More money doesn't solve anything. It just means that prices have to go up because money doesn't create wealth. It doesn't create purchasing power, right? It creates phony demand, but now prices have to rise to clear the market because it doesn't mean that there's more goods. The only thing that works is more goods, more production, more wealth, more factories. We're not going to get any of that on our current policy. We're going to get the opposite of that. Hey, by the way, I want to make a couple of quick notes. I will be on CNBC Fast Money lunch report. I think immediately after this show, or at 12:30, I think Eastern time. I'm slided to be on that live from this studio. So if you want to hear a little bit more, Peter Schiff, watch Fast Money halftime at 12:30. Also, I just found out I'm booking the Mike Huckabee show on Fox News on Saturday afternoon, which is a first. Huckabee, Greta Van Susteren. I mean, I've never been on these shows before. I guess the only thing that's happened is, I testified before Congress, and maybe that put me on the radar over there at Fox News, although when I ran for Senate, it would have been nice if one of these shows had put me on. Of course, I tried my best to get on when I was a Senate candidate, and nobody would talk to me. But by going to Congress and testify about how the government fined me for hiring people, somehow that's getting me on. But hey, whatever it takes, I'm glad to do these shows and get the publicity. And I'm thankful to Fox for stepping up now and having me on the shows. Although one thing is disappointing me, I found out one of the Fox hosts, Sean Hannity, who never let me on his show. I really tried to get on his show. But I'm disappointed that Sean Hannity is now signed on to be a spokesman for Goldline. I guess now that Glenn Beck is no longer on Fox, even though Goldline is sponsoring his Glenn Beck TV, they needed a bigger guy on Fox. So now they got Sean Hannity. They're now the exclusive gold dealer for the gold advertiser for the Sean Hannity a radio show, and that's very unfortunate for Sean Hannity's audience because now they're about to get ripped off. Remember, Goldline's typical markup is 67%. That's their typical. So if you want to buy some gold from Goldline, 67%. Sometimes they mark up 100%. So what does that mean? If Sean Hannity tells his audience, hey, go buy some gold from Goldline, and let's say one of his listeners wants to buy $10,000 worth of gold, they've got to send Goldline a check for about $17,000 to get $10,000 worth of gold. And a lot of that $7,000 that they're paying gets recycled right back to the Hannity show to pay for all those high-priced ads. It's a vicious cycle. I don't know if Hannity understands the extent to which Goldline is going to be ripping off his customers. He ought to do some due diligence or ask me. I mean, he has to question where are they getting all this money to afford to be my exclusive sponsor. They're getting it from your audience who is going to be overcharged for gold. If somebody wants to buy gold through a legitimate dealer, like maybe mine, Euro Pacific Precious Metals, if they want to buy $10,000 worth of gold, they only have to send $10,200 or $10,300. I mean, that's it. It doesn't cost that much to buy gold, but it costs a lot to advertise on television and radio. And if you want to recoup those costs, the only way to do it, I guess, is to gouge your customers. So I would suggest that people, if they're interested in finding out more about this, go to my website, goldscams.com, and download my special report on all the scams being used to separate gold buyers from their money. Because believe me, when you need a 70% move just to break even, you're better off not buying the gold at all. Although in the long run, yeah, I mean, I think the people will get back to even. But hey, you're buying gold not to break even, right? You want to make some money, so you want to make money for yourself, not for the dealer who sells it to you. So go to goldscams.com. Look at my report, and anybody who you know who's a fan of the Sean Hannity Show, make sure they read this report before they fall for any of the gold line cons. Anyway, I'll see if I can well, actually, I don't think I have time to take a call. We got a guest coming up at the top of the next segment. So we got a guest, and then we'll be talking economics, and I will try to we got a lot of calls on hold. Unfortunately, I just had a lot to talk about. I will pick up the calls at the top of the last hour. One more thing I wanted to comment about. You know, I've been watching on ABC News this Made in America segment. They went over college catalogs, and they were in a big uproar among the students about how that these catalogs, all the merchandise is made in China. And they thought this was terrible. You know, I mean, the whole thing is ridiculous. I bet if you looked in the closets of all these students in these colleges, there isn't a single garment that was made in America. All their clothes are made in China. And apparently their parents were upset. Let's look at their parents' homes. You know, why are all these things made in China? Because they make stuff for lower prices. Now, ABC was trying to pretend that that's not true, that there's all these companies that could make the same stuff just as cheaply as China. That's not true. I mean, if it was true, they'd be buying it. Now, can you find a small store that might be able to, on a small scale, deliver these products? But they can't do the volume. They can't do the scale. They don't have the capacity to mass market the merchandise like these Chinese companies. They can low produce in high quality. These American stores can't do it. I mean, if they could, believe me, they'd be in these catalogs. There is no conspiracy to not buy American. When companies are trying to sell, they're trying to get the lowest price at the highest cost. They're not looking about borders. They're just looking about the bottom line because that's what their customers care about. And the reason that these college catalogs are selling all this merchandise that's made in China and not made in America is because it's cheaper. And, you know, the college students are all on a budget. They're trying to save money, and so they're buying these products. If you made these catalogs fill up all their merchandise with American-made products, it wouldn't be like ABC News says, that the price wouldn't be any higher. The price would be a lot higher. That's why they're not buying in America. The whole thing is ridiculous. Yes, we need to make things in America, but we can't just force people to buy them there. We need to lower taxes and repeal regulations so we can produce things at a lower cost in China. That's what we need. We need less government. We need lower labor costs and more capitalism, not just some campaign to buy American. Anyway, hey, stick around. We'll be right back on the Peter Schiff Show at SchiffRadio.com.
Schiff Show. We now return to the Peter Schiff Show. Call in now, 855-4-SCHIFF. That's 855-472-4433. Radio, the Peter Schiff Show.
And this is Peter Schiff here at SchiffRadio.com. And joining the conversation, Dr. Raymond Lumbra. He is a professor of economics at Penn State University. He's an associate dean of research and college advancement. He's a former associate professor of the University of D.C. and George Washington University. He's also a former staff economist at the Federal Reserve Board of Governors. He has actually consulted with the U.S. Banking Committee in Congress, the Federal Reserve Congressional Budget Office, Joint Economic Committee, the IMF, the Senate Banking Committee, and the U.S. Treasury. Dr. Lumbra, welcome to the show.
Good morning, Peter.
So have you consulted with anyone at Congress or the Fed recently?
Well, I'd say informally with various staffers, and I also consult with some Wall Street firms. But just because they talk to us doesn't mean they follow the advice they get.
Okay, so that it's not your fault then. They're not following your advice. They're ignoring it. So I guess.
Yeah, Yeah, I'm not saying we have all the right answers either.
Well, what is your advice? I mean, I just went before Congress last week to try to testify on what they can do to help the economy, or more importantly, how they can stop hurting it. But you know, what was your advice? I mean, what are you telling Congress and the Fed? What should they be doing right now?
Well, I think we need to dial back a little here. We're obviously already entered the silly season as for the run-up to the election. And you could ask yourself what reasonably could be accomplished over the next 13 months. And I think a lot less than people are imagining.
Well, I don't even think that we should be pursuing fiscal policy or monetary policy with the goal of an election in mind. Our leaders need to be thinking longer term.
Oh, I agree with that. But we know that more the Congress and the President, of course, than Ben Bernanke and his colleagues. But they certainly are fixed on the next election. As you're suggesting, that's going to lead to bad policy.
Yeah,
I mean, the whole idea of setting the Fed up the way they were set up was to give it the freedom to act in the best long-run interest of the nation, even if not in the best short-run and political interest of its elected leaders.
But it never seems to do that. It always seems to try to reelect whoever the incumbents are, and that's generally how they pursue policy.
I think there's certainly been periods like that, and I don't know if you want to turn this into a discussion about Ben Bernanke, but I've read, and I'm sure you've probably talked about the Republican leader's letter to him in front of the Federal Open Market Committee. I mean, he's worried about the economy, and the question is, what, if anything, can the Fed do? And I mean, I would say the actions they took yesterday are pretty modest. I think if we got him hooked up to a lie detector and said, do you really think this alone, these two actions that were announced, are going to make a big difference? He would say probably not. But
well, if we hooked him up to a lie detector, it would probably break due to the excess activity. But you know, I think he's going to ultimately give the market what it wants, which is more money from helicopters, because this economy is imploding. The problem is they're trying to resurrect a Frankenstein economy. We have to let the U.S. economy die so that a real one can be born to take its place. We can't try to preserve an economy where we just spend borrowed money. That is what the Fed is trying to do, and it won't work. Meanwhile, the banks that were bailed out before are all going to fail. So what's the Fed going to do? Is the Fed going to let them fail this time?
Well, you've covered a lot of ground there. I would say that Ben Bernanke knows more than most people on the globe about both the Great Depression and I'd say the lost decade in Japan. And I think that the common threads he draws from those experiences is that it's worth trying some things, even if in retrospect they didn't do much good, as opposed to doing nothing. And, you know, history is going to have to be the judge about which specific initiatives made a difference. But I do want to sort of go back a little bit here, because I think there's a tendency to look at what's happened in the United States over the last few years as akin to a normal recession. The way we talk to our students about it is, you know, the economy catches a cold, maybe even the flu. When, to my mind, what the economy suffered was more like a stroke. And we know the recovery from stroke can be long, and it's going to take a lot of patience and attention to long-run therapies. And
absolutely, but
I
think
our political system is not very patient.
I think the problem is every time we actually caught a cold in the past, the way the government cured it was just to cover up the symptoms and let us get sicker. And now we're so sick from all these prior government stimuluses that this last one is actually the one that's going to kill us. And that's why the economy is dying, because the government continues to administer the toxic medicine that prevents the free market from healing it.
Well, I'd certainly agree that if we took the stance that policymakers are kind of out of short-run remedies, that may be a good thing. The question is whether the longer-run adjustments in taxes and expenditures and regulation, in particular on the fiscal policy side, can create a more stable environment for businesses and consumers to make good decisions. And there's really not much hope that any of that's going to happen in the next 14 months unless the economy slides a lot more than most consensus forecasters see it at the moment.
Yeah, well, I think we're in a recession already because I think we're in a depression. So I don't think it ever ended, and I don't think it's going to end. I think it's going to be with us probably for the balance of this decade because I don't know that the government is ever going to do the right thing. I think they're going to keep on stimulating, and we're never going to get out of this. We're just going to dig the hole deeper.
But part of it is maybe instant analysis and the 24/7 discussions and the way politicians can get trapped sometime by saying things that maybe in the more full reflection they don't really believe. But it seems to me we're in an environment where, just to take one example, this discussion about should we or shouldn't we raise taxes on the rich. If we stop the average person in the street, I'm guessing, I think it's true, that the president and most of the Democrats understand that the wackiest thing you could do between now and when the economy were to sort of regain its feet would be to raise taxes. But that nuance, it gets to be a discussion about raising taxes now and cutting Social Security benefits now and Medicare. When that would be crazy. I think what the markets are looking for, and I'm guessing what you're imagining the economy needs, is we need a path to a more stable fiscal environment. And
absolutely, but
we have to be sensitive to where we're starting from.
But part of the
mistakes that were made in the Depression were that we allowed aggregate demand to contract even as it needed to be boosted.
Well, I would disagree with that. I think that we've had too much demand. We've bought things we couldn't afford. That's the problem. We need more savings. We need to produce more. But the whole thing on taxes, I mean, the problem with our economy isn't that the rich aren't taxed enough. I mean, the rich are paying plenty of taxes. But when people object to raising taxes in a recession, they do that because, well, it takes money away from individuals. Well, so does government spending. I mean, the problem is when you run a deficit as opposed to taxes, that actually damages the economy more than the taxes. So if politicians are worried about draining the economy of resources from taxes, they really need to be worried about draining the resources from government spending. So what we really need right now is massive government spending. That's the only stimulus that's going to help, massive cuts in government spending.
Yeah, I would disagree that that's the route out of this, where we are right now today. I think over the longer run, there's no question that government spending is too large. And, Milton Friedman certainly understood that actually the route to long-run prosperity was to cut spending for.
So then, how do you think we get out of this? Then we run big deficits and let the government spend a bunch of money. I mean, how does the economy recover?
I don't know any economist. Well, I shouldn't say that. Most, I think, rational and economists believe that we need a lot more fiscal discipline over the longer run than we've seen.
But we don't need any now.
Get there,
But what about right now? What do we need to do right now? What should the fiscal policy be right now? What should the monetary policy be right now?
I don't think the Fed could or should do much more than it's done already. We got liquidity in the system, and a little tick down in interest rates is not going to make any difference.
I agree. In fact, I think it makes the problem worse.
Consumers that can't get access to credit for a lot of reasons, including the aftermath of the 2000.
Right, but the last thing we want is more consumer credit. I mean, because we don't want more spending on borrowed money. We want that credit available for investment and production. So that would be a bad thing if consumers got more credit.
Consumers are rebuilding their balance sheets, and what you're suggesting really is that the government needs to rebuild its.
Absolutely.
And I agree with that over the longer run. But I think cutting aggregate demand right now, if the government cut back, would be exactly the wrong policy. On the other hand, laying out a path, and I've seen lots of different plans, and certainly the Deficit Reduction Committee, the earlier one and the one that is operating now, understand both the need for a path and the general outlines of what it's going to involve.
Yeah, but the problem is
the political will there to do it.
But what you're suggesting is that we make that path more difficult. You're saying we have to run bigger deficits now so that we can tackle the deficits later. But the bigger we make them now, the more difficult it is and the less likely we're ever going to tackle them.
Well, I don't think you asked me what I would do on fiscal policy today, but
what would you do? I did ask you. What would you do?
I would. My first order of business would be to lay out the path to fiscal balance over the next 5 to 10 years.
All right, well, we're going to have to hold that till after the break, but I'd like to know what we're going to do about the deficit this year, next year, right away, not the path of the future, because we can't force Congress to follow that path. What counts is what they actually do right now. So think about that during the break. We'll be right back. This is Peter Schiff on SchiffRadio.com.
The Peter Schiff Show. Since the Peter Schiff Show was last on the air, the national debt added another $7.89 million. Luckily, Peter's intelligence is growing twice as fast.
That's incredible.
Welcome back to your source of sanity in an insane world. It's the Peter Schiff Show.
And this is Peter Schiff on SchiffRadio.com, speaking with economics professor of Penn State University, Dr. Raymond Lumbra. And, Doctor, so I wanted to know, so not about a plan for the future. What do we do right now? I mean, what does Congress do for this current fiscal year, if anything, to help the economy grow?
Well, I would say damn little that they could do to improve the economic performance over the next year. I would say beyond that, because I think a lot of the momentum or lack thereof is already set in place. I think that we're going to be given a lot of false hope by some. I would have thought we already learned the lesson that there aren't really such things as shovel-ready projects, so we're hearing more about infrastructure. I guess the president today was going to be out at some bridge in Kentucky saying this is what we could fix up. But what we've learned is by the time Congress enacts something and until a job gets created is a very long time, and it has much smaller impacts than were envisioned at the time that the policies were pushed. So I think that's not a route forward, really, over the next 14 months. I think extending the payroll tax cut won't hurt and could help. But I think the most important thing that Congress could do is get together on a longer run framework for cutting spending and I think adjusting tax revenues, whether we could debate whether it should be closing loopholes and lowering rates, but whatever, we need to be able to adjust the revenue.
But how do they do anything long term when whatever they pass today is not binding on any future Congress? Whatever they do can be undone.
And I've thought about that. You know, political scientists have looked at whether term limits would make a difference. You know, I remember back when I was in Washington, for quite a while, I think the Graham-Rudman-Hollings budget rule that was put in place did have some significant impact in retaining spending. And I think looking back at that kind of approach might make some sense. And the process...
it couldn't have worked too well because, I mean, obviously we got rid of it, so that was part of the problem, right? We were able to get rid of it.
I think it did restrain spending relative to what it would have been, and then it got abandoned. So let's learn from that. This time around, this committee that's meeting knows if they don't come to some agreement on deficit reduction, there'll be very large cuts to the military, and some of them are not too happy about that. So there may be a lever that's been uncovered here that helps bring some discipline over and above what rule they agreed to.
Yeah,
so
although
there's institutional arrangements that have to be adjusted here. There isn't an argument that you're going to make or I'm going to make that by itself is going to change the path to fiscal
I think
stability.
big cuts in military spending would be a good thing. So I just assume let them go through. I don't think it's going to jeopardize our security. I think what's jeopardizing our security is all the money we're wasting on excess military spending, among other things. But here's the problem. See, if I'm right and the economy never recovers, then how are they ever going to deal with these deficits? They're always going to say, well, we can't raise taxes in a recession, we can't cut spending in a recession, and eventually interest rates are going to go up because inflation is going to be such a problem that they're not going to be able to stay down. And then what do we do? What do we do with all of this debt that's financed with T-bills when interest rates are going up? I mean, is the government going to spend all of its money on interest and nothing on anything else, or are we just going to turn on the money presses full
Well, I think
steam?
that's a little extreme, but I'm thinking that's one of the reasons you recommend people be in precious metals. But I'm not as pessimistic as you are at the moment, I think. But, as we're
about what? You don't think interest rates can go up? You don't think interest rates are ever going to go up? No, I'm not talking about today. I'm talking about
voting, though. It's voting every day.
Right, but I'm saying, let's say over the next 5 or 10 years. I mean, do you think interest rates are going to stay at these ridiculously low levels?
No, of course not.
All right, so what happens when they go up to a normal level? The government can't afford to service the national debt with normal interest rates, let alone high interest rates.
Well, not if you hold everything else constant, but everything else is hardly ever constant. And I think that it's.
Well, what do you think is going to happen? Are we going to have just enormous economic growth that's going to make these huge deficits financeable at higher rates of interest?
The current set of policies we have in place.
Right, but we could have higher interest rates. We could certainly have a big pickup in inflation. What if the Chinese decide to?
I wouldn't expect that unless and until aggregate demand strengthened considerably.
Well, what about aggregate demand in China? What if the Chinese come to their senses and let the dollar drop against the RMB and the Chinese currency were to just skyrocket in value, and then China was to go on a global buying spree, and the Chinese people started.
Obviously, a thing that didn't stay equal. So we could list all sorts of things which would change the economic outlook, and that would certainly be a significant one. And policy would need to be adjusted in light of that, and we'd have to hope and expect the Federal Reserve would extract a lot of the liquidity that's in the system to deal with the inflation that was beginning to emerge.
Yeah, and when you keep focusing on this aggregate demand that we need the government to supply aggregate demand, all the government does supply is inflation. All they do is buy what's been produced. They don't increase supply. They just increase demand, and so prices have to go up, or prices are prevented from falling, which might be something that would help the economy. But just having the government spend money isn't going to grow the economy.
Well, I just think it's a component of aggregate demand. It's not the only source. So we all.
But where does the government get the money? I mean, if the government spends it, somebody else doesn't have it.
The consumer is the most important part of the economy, and proportionally. And
I would disagree, because if nothing is produced, what is he going to consume? Where's the consumer if there's no producer?
Well, producers will produce when demand picks up.
But there's always demand. I mean, everybody wants things. I mean, the question is, you have to be able to supply it. You have to be able to create it. There's all sorts of things that I'm sure that you would like to have that you don't have because you can't afford it. I mean, it's not because you don't have demand. You just, you just don't have the means because stuff isn't cheap enough.
This is an old debate: does supply create demand or demand create supply? And the fact is, markets reflect both supply and demand. So that's my position, not that one. I'm saying right now the economy is operating well below its potential. Firms are not – they have less employees. Their plants are more idle than they would be in the face of a pickup in their orders. So we could take the stance. There's virtually – that's just going to have to work its way out of the system.
Yeah, I think what prevents them from producing is they lack the capital. They can't do it at a low enough price to produce goods that people can afford.
Capital? Firms are sitting on an enormous amount of funds.
Well, funds are
right now,
but that doesn't mean. But that's not a factory. That's not that. Just because they have paper doesn't mean they have a machine.
Oh, but there are very few firms that would tell you today that they're not hiring because they don't have more factories to put them to work in.
Well, they can't.
There are a few, but there aren't many.
But they can't produce things at a competitive price that people can afford to buy. That is the problem. We have to restructure the economy. Hey, anyway, it's an interesting discussion. Maybe we can continue it on another program. But thanks for stopping by. And hey, ask any of your kids over at Penn State if they read any of my books. I'd be interested if they have. Anyway, hey, this has been Peter Schiff here at SchiffRadio.com. Stick around. We'll be getting to your calls at the top of the next hour.
The Peter Schiff Show.
Brothers on the slide. What you gonna hide?
no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans, and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on. Call in now. 855-4-SHIP. That's 855-472-4433.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
This is Peter Schiff here at SchiffRadio.com. Hour 2 of the Schiff Radio Show underway. Now we're taking your calls, 855-4-SCHIFF. You know, many of the people that were on hold prior to my guest seem to have dropped off, so the board is relatively open if the people who dropped out want to call back. We do have some people on the board, but there is room for more calls, 855-4-SCHIFF. Well, you know, the stock market tried to rally during the first hour of the program, although it never, mounted much of a rally. But now we look like we're headed back to make new lows. The Dow is once again down about 350 points. A number of the metal stocks had pretty decent rallies. Of course, they're all still way down, but now gold is heading back down towards its lows as well. The market is under some very, very intense selling pressure, a lot of technical pressure bearing down on the market. And the strength of the dollar, of course, is not helping. In fact, it is hurting. But I do believe that anybody who's buying the dollar will soon regret it. Certainly people who are buying treasuries are going to regret it. I mean, people are paying now, they're buying 10-year treasuries. They're getting 1.7% in dollars per year. On the 30-year, it's 2.86. I mean, is anybody who's buying the 30-year treasury today, do they plan on holding that thing to maturity and collecting 2.86? I doubt it. So what's going to happen when all the people who are buying these treasuries want to get rid of them? Who's going to take the other side of that trade? Hey, just Ben Bernanke. And, of course, that means he has to print money, and that means it's even a bigger disaster. And I think it's coming. And I said I think the Fed's going to cry uncle. Just, we get the Dow down below 10,000. We get these bank stocks really hurting. We get some more bad economic numbers. They're going to do what they do, I think. I think that it's going to be more stimulus. It's going to be more money. It's they can't sit there and do nothing. And I know it's very easy for some of the Republican candidates to criticize Ben Bernanke for QE2, but believe me, they'd rather have QE3 than a imploding economy. They just don't really understand the nature. I think Ron Paul understands it, but I don't think any of the other Johnny-come-lately Tea Party candidates who have jumped on to criticize the Fed bandwagon really know what they're talking about or understand really what's going on with the U.S. economy and the Fed's role in artificially propping it up. Of course, we don't want to artificially prop it up. The only solution is to let it fall so that we can replace it with something sustainable. But nobody wants to live through the pain, and so we're all going to live through excruciating pain as a result. But anyway, let me go to the phone. Seems like the boards have now completely filled up. But one person who's stuck around for the entire break is Tristan, calling all the way from Australia. Tristan, welcome to the show.
Hey, Schiff, how are you?
Good. How are you?
Yeah, I'm all right.
Maybe your parents were Legends of the Falls fans, but anyway, what's going on down under?
Oh, nothing much. I'm just up late. Watched markets for a while. It's a bit of a scare, but I'm chewing my way down, so that's all right. But anyway, I'll ask you about this Operation Twist. I know they did a little something, a previous operation in the early 1960s, and I'm wondering what kind of effect that had. And
well, obviously, it couldn't have had much of a positive effect because the 1960s is what gave us the 1970s. It was the profligate, loose money policies of the 60s combined with big deficits that produced the inflation of the 70s that ultimately we had to cure with 21% interest rates. We didn't twist our way out of the problems back then. And we're not going to do it now. I mean, it's a much better dance, I guess, than it is a monetary policy. But I guess what's happening is it's just desperation. The Fed is trying to do something. to act like it's helping. But it's not going to work. I mean, the only thing that will work, and I put that in quotes, is aggressive money printing. But that isn't going to work.
Mm-hmm.
It'll stop the markets from falling. It will give Americans more money to spend, but it's not going to give them more purchasing power because prices are going to go up. But that's
exactly
that's what they want. I mean, that's unless they want to acknowledge the true problem, that's what they're going to do. Because if they don't do that, they have to let the banks fail again. I mean, are they really going to do that? I mean, they didn't do it last time. Why should they do it this time? Especially when it's going to be worse.
Yeah. Oh, I'm wondering if they knew it was a deflationary action in the early 1960s on the short term. Is that an intended consequence for Bernanke? Because I know the US dollar has lost a lot of its luster, and just the result of this announcement yesterday, our dollar is down to 97.
The Australian dollar has lost luster, as has the Canadian dollar. The Canadian dollar is down even more. It looks like it's down almost 5% in the last couple of days. But yeah, the Aussie dollar is now trading at about 98 cents. This is the lowest it's been in a while, although it's still at a big uptrend. And I'm still very positive on the Australian dollar. But you are just having traders. I mean, there is a lot of trading money sloshing around in the forex markets. There's a lot of leveraged players who are trading, and I think that is what determines a lot of this short-term volatility. I don't think long-term the upward trend in the Australian dollar is going to be changed by this noise. And ultimately, again, when the Fed throws in the towel and basically quies uncle and gives the market what it wants, it's like the little children are having a tantrum until they get their toys and their junk food, and it's going to work, because the Fed has spoiled all the kids on Wall Street. It constantly gives them what they want as long as they make a big enough tantrum, and obviously they're doing that now with the Dow down 365 points and falling like a rock.
Yeah, so you think Bernanke is going to step in soon?
Yeah, I mean, I think he will. I mean, I think that as it gets darker, he will not be able to resist the impulse to come to the rescue. I mean, that's what the Fed has always done, and ultimately that is what Congress is going to be wanting. They're going to be demanding something, and it's going to come from the Fed. Now maybe the Congress will just say, look, we need even more deficit spending. Maybe they need bigger stimulus checks. Maybe what they want to do is send everybody a $10,000 check, right? Hey, that would really work, right? If everybody had an extra $10,000, well, they can make those mortgage payments. They can go back to the mall. Hey, it would be a great Christmas. What a Merry Christmas if we all had a $10,000 stuffed in our stocking by Uncle Sam, right?
I can't believe people actually believe that's a legitimate action to take.
Well, who knows? We might be going there because that is the mindset that we have, right? More spending, more money to spend, put more money in consumers' pockets. That's what they want to do.
Yep. Yeah, that's a bit scary. But I want to say one more thing. Ron Paul 2012.
Well, unfortunately, you can't vote for him out there in Australia, but I'm glad that the Ron Paul revolution has spread around the globe. Is there a Ron Paul candidate running anywhere in Australia you could support?
Well, we're trying to start up our own libertarian type party in Australia, but it's in the infant stages now. But libertarianism isn't really a high point on Australians' wish list, I think.
All right. Well, hey, good luck to you guys, and get some sleep. I know you're up late. Next up is who's on hold the longest? I guess it's Peter in Queens. Peter, welcome to the show.
Hi, thanks, Mr. Schiff, for taking my call. Do you think, you're saying the Fed in the near future or distant future can't keep rates down, and if the rates do go up, kind of like in the 1980s, could that be bearish for gold? And will Australia join the race to the bottom in the currency war?
I don't think that they will join that race. They haven't given any indication that they would do it yet, so I don't think they will. Now, yes, eventually the Fed is going to lose control of rates, but it won't be bearish for metals until the rates get very high in real terms. So my belief is that when rates finally start to really rise, they will still be rising more slowly than the increasing rate of inflation. So if rates are at 10%, but inflation's at 15%, that's negative 5%. That's very bullish for gold, not bearish. Anyway, if you want to stick around, if you have a second follow-up on your question, be happy to let you hold. We got a commercial right now. We'll be right back on the Peter Schiff Show at SchiffRadio.com.
The Peter Schiff Show. To President Obama, Secretary Geithner, Madam Pelosi, and all of the socialist econ professors across America, we're sorry. We're sorry. Peter Schiff is back on the air.
And it is Peter Schiff here at SchiffRadio.com. We're taking your calls live at 855-4-SCHIFF, 855-4-SCHIFF. Watching the Dow Jones closely, now down, still down about 365 points. Kind of the free fall is on hold right now. We're not really breaking below new lows. We're kind of holding at the lows from earlier this morning. We'll see how the day progresses. I doubt that the lows are, in fact, in. The technical damage looks severe, and a lot of times in the markets, you come in and get a lot more selling later in the day, particularly in the last hour of trading. And I think people are going to be bracing themselves, too. You know, when you get these big down Thursdays, oh, no, what about Friday? And then, oh, what about the long weekend? So it gets very scary when you get these big down Thursdays. Anyway, let me go back to the phones. Next up is Josh, who's calling from Maryland. Josh, welcome to the show.
Thanks, Peter. It's good to talk to you. I'm glad you're finally getting some notoriety and your name out there. Hopefully some more people will tune in and listen to you and hear the message that you're delivering.
Yeah, I just got another booking. I got another booking, too, unless for some reason it gets canceled. But I'm also now scheduled to be on Fox Business later today, sometime between, I think around 4 o'clock, somewhere between 4 and 5 o'clock, but maybe closer to 4. So I got CNBC Fast Money at 12:30, then Fox Business at 4, and then Huckabee on Saturday. I'm trying to debate whether or not I should go. They want me to come into the studio on Saturday, so I'm trying to decide whether I want to make the trip into New York with my son, who I have for the weekend, and go to do the Huckabee show on set, because apparently they have a live audience there for his show.
Go for it. Hopefully you can, convince some of these warmongering neocons that their way is not working. But anyway, I have a question about the price of gold. My mom, this is more towards my mom. My mom is in her 60s now. She just turned 60. And she, obviously retirement's in a very near sight. She doesn't have a whole lot saved up, maybe around 150,000. And she talked to your firm basically about transferring money over. Anyway, that's in the process. But I'm trying to get her to take a little more drastic action before, there's a huge market correction, as I think we all know is coming. I'm actually trying to talk her into a home equity loan to actually buy physical gold and silver bullion to store in her house. What do you think about that idea?
I don't know. I mean, I hate encouraging people. I mean, you're talking about a home that's fully paid for?
She's about to pay it off.
Yeah,
within 6 months.
Yeah, I don't know what the real estate market is, I don't know all the other circumstances regarding your mother's situation, but it's, for somebody who's older, who doesn't actually have an income, maybe she's retired, she doesn't have a job. I mean, it's you obviously put your home in jeopardy if you do that. You get no income from the gold. If she's already got $150,000, I'm sure we'll be able to put some of that money into gold already without having to lever up her house to do it. I mean, the only time I think it really makes sense to take out a loan, and she could certainly take out a modest loan against the house if you can get these ridiculously low rates. I'm about to refinance again. I mean, if you don't have a jumbo, you might be able to get a 30-year mortgage under 4, but of course your mom probably doesn't even need 30. Maybe she can get a 15-year mortgage in the 3s. Can she take some of that money and invest it in income-producing foreign assets that would pay her 6 or 7%? Yeah, and then she can actually increase her income. So, that might be more appropriate with a small percentage. That's, but she's got to understand the risk too, because obviously if you buy some stocks and they go down, or the dividend, the more important is the dividend. What if the dividend gets cut and now all of a sudden it's not enough to carry the mortgage payment? So there's a lot to consider, but I don't know that I would really push her too hard in that. I mean, I think we'll be able to get her some exposure to gold just based on the cash that she's able to send us without having to, make it a levered bet.
Okay, very good. Thank you. And one more note. I just heard my buddy Alex Jones yesterday say that he had an interview coming up with you, and I'm looking forward to that. And let me just say,
well, I just did an interview with Alex Jones. I don't know if that's the one he's talking about. If it was taped, I know I did something for on Skype with him on I forget what he calls the program, but I don't know if he's referring to the one I've already taped or if there's something else in my calendar.
Okay,
Revolution Radio, whatever it was, or Revolution Media. All right, but it was a good. I think it's already up on YouTube. I saw, several YouTube clips that somebody put up of my discussion with Alex Jones. So you might not have to wait. I mean, if that's the one, you just go on YouTube and check it out. Anyway, next up is Aaron calling from. Is that Ohio or is it Canada?
It's Edmonton, Alberta, Canada.
Oh, Alberta, Canada. Okay, yeah, that's what I was thinking, but it didn't fully say that. So anyway, how are things up there in Canada?
Cold, but it's all good.
Yeah, it's already cold? All right, well.
Starting to get cold. I guess, Peter, I'll piggyback on the last caller. Real estate is what I do for a living. I buy and sell residential property. But in 2008, I started leveraging off properties and buying precious metals. Obviously, I did okay from that point to now. But I'm kind of in a spot where I'm thinking, should I keep doing that same thing, or should I start getting into some of the commercial real estate or bigger?
Well, you shouldn't be getting into commercial real estate. I mean, I think, I don't think it's right. In fact, I talked to a prospect yesterday who was very heavy in apartments, and he owned a lot of multifamily units, and he said the demand was great, the cap rates were ridiculously low, he could sell them very quickly, and I suggested that he do that. I mean, I think it's a function of interest rates. I mean, all of these things that throw off income are valued now based on the fact that interest rates are so low, but they can't stay low. Obviously, look, they've been low for so long. I mean, it's amazing that they're as low as they are. So it's hard to say when they're going to turn around. But I think, when this bubble pops, it ain't going to be pretty, and it's going to be quick. And so you don't want to own that real estate when it does. And I think you got to take advantage of the fact that you've got buyers out there for this stuff, given how low rates are. So I would be a seller of real estate, not a buyer. That'd be my advice.
So I guess the other play that I was thinking about, what you just confirmed there, then, is continue to just keep selling to the people that are interested in buying and shifting that money over into either stocks or more metals.
Yeah, foreign stuff. Look, if you want to buy real estate, you want to buy it in Asia. Buy it in China. Singapore, Hong Kong. Buy it where the wealth is growing, or even buy it in Scandinavia, or buy it in Australia. I mean, you want to own real estate where people are going to get wealthier, not poorer, because real estate ultimately is going to be a function of what you can rent it out for, and you can rent property to rich people for more than you can rent it to poor people. And America, unfortunately, is going to increasingly be a nation populated by poor people. A lot of Americans are going to start moving in with each other, having roommates. A lot of people are going to start renting out rooms in their houses and taking on boarders. You're going to have several families living in the same house. That's going to put downward pressure on real estate values here in the United States. Anyway, hey, stick around. We got another segment coming up. If you have another follow-up question, I'd be happy to have you hold on. If not, thanks for calling. Everybody else, we'll be back for more of the Peter Schiff Show on SchiffRadio.com.
The Peter Schiff Show. We now return to the Peter Schiff Show. Call in now, 855-4-SCHIFF. That's 855-472-4433. Real Radio, the Peter Schiff Show.
Yes, this is Peter Schiff here at SchiffRadio.com. We are taking your phone calls. Another half hour of the show coming up, so make sure to stick around. 855-4-SCHIFF. Still on hold with me is Aaron from Edmonton, Canada. Aaron, you had a follow-up question.
Yeah, I agree with you as far as the U.S. Housing market and commercial goes, but being in Edmonton, we're kind of driven by the Canadian oil sands here. So Does your comment still apply for where we live, buying commercial and residential apartment buildings and all that sort of stuff, where people, if you believe in oil, I guess, where people are going to be coming to this economy?
Yeah, I do believe in oil, and I am much more positive on the outlook for Canada. So I am not adverse to real estate in Canada the way I would be in the United States. So, I mean, owning, particularly if, you're talking about agricultural real estate or resource, where there's resources, that real estate actually could gain in value. But you've got to look at your local markets, and whether it's residential, you've got to look at the prices relative to rents and make sure that, the market is not currently overpriced. But, yeah, I mean, I'm far more optimistic. And, in fact, I think that a lot of American real estate is ultimately going to be owned by Canadians. I think a lot of the real estate in South Florida, I mean, you mentioned how cold it gets up there in the winter. Well, it's pretty nice in South Florida, and a lot of Americans who are currently living down there, a lot of retired people might have to sell their houses in Florida and move north to live with their kids because they can't afford to live down there anymore, and they'll probably be selling their homes at bargain basement prices in Canadian money. So I do expect to see a lot of Canadians picking up some bargains in the U.S.
Okay, because what my play was, I guess, was to buy a lot of gold and silver, and while the interest rates were low, wait for the interest rates to rise, obviously negatively affecting the housing prices, and then selling all of the precious metals to go in and be a cash buyer when the real estate prices.
Yeah, well, that does make sense, and I believe that will happen. I think real estate prices now, in terms of gold, are going to come down even in Canada. So, yeah, that wasn't how you asked the question. I thought you were talking about it maybe in terms of Canadian dollars. But, yeah, I do expect real estate prices to fall in terms of gold, and that might make a strategy. And I do expect interest rates to rise in Canada. They're still much too low. And, yes, higher interest rates can have a detrimental effect on home prices. So
where do you see the signals, or where would be a trigger that this is going to start happening, or?
Oh, look, I don't know. I mean, I think you've got it's taken a while for this bond bubble to burst. I mean, they've thrown a lot at it so far, and it hasn't. But even this big increase in the price of gold, I think you're going to have to start seeing the market. You have to start seeing bond prices weaken. That'll be a good sign that they're actually going down on bad economic news instead of up. That'll be a sign that the market has finally figured it out. All right, but hey, thanks for your call. Hey, before I go back to the phones, I wanted to play a little sound. I've got some sound from a Senate candidate, Elizabeth Warren, in Massachusetts, proving that she knows nothing about capitalism, which I guess would mean she's ideal for a U.S. senator. She'll be right at home. But anyway, here she is trying to explain how the country got rich. Here, cut number one.
Hear all this, well, this is class warfare, this is whatever. No. There is nobody in this country who got rich on his own. Nobody. You built a factory out there, good for you, but I want to be clear. You moved your goods to market on the roads the rest of us paid for. Yep. You hired workers the rest of us paid to educate. You were safe in your factory because of police forces and fire forces that the rest of us paid for.
What a bunch of nonsense. If we didn't have police and fire departments, we could probably protect ourselves for a lot less money than the taxes these businesses had to pay. The businesses paid taxes to help pay for the police out of the profits that they generated. Where do you think the government got the money to pay for the public services? They got it from taxing the businesses and the people they employed. But without the businesses, there would have been no income from the workers, and the government would have had nobody to tax. She's got it backwards. The wealth came from businesses. The reason that the government could afford to build the roads is because the businesses created the wealth that made the roads possible. She's got the horse before the cart, not the other way around. And, of course, talk about the workers that we educated. A lot of these businesses, in fact, we didn't educate the workers. The workers come there, they need remedial education. They got to be trained from the bottom up. Part of the problem is we're not educating the workers the correct way. They got to get educated on the job. I mean, it is incredible for her to try to claim that it's government. It's government spending money that is the reason that businesses succeed. I mean, because if it worked, why didn't it work in the Soviet Union? Why doesn't it work in all those communist countries that try what Elizabeth Warren seems to believe in? Anyway, here's some more of her nonsense. Cut number two.
You didn't have to to worry that marauding bands would come and seize everything at your factory and hire someone to protect against this because of the work the rest of us did. Now look, you built a factory and it turned into something terrific or a great idea. God bless. Keep a big hunk of it. But part of the underlying social contract is you take a hunk of that and pay forward for the next kid who comes along.
First of all, what is she talking about? Keep a big hunk of it. You already don't. The government already takes a big hunk. I mean, what is again? I'd like to ask Elizabeth Warren the same question I asked Dr. Boucher. What's enough? I mean, if you're a factory owner in this country and you're making a decent living, you're already giving close to half of your money to the government. I mean, at least 40% minimum is going to the government. So 40% isn't a big enough hunk? I mean, what kind of hunk is she talking about? I mean, I can understand if taxes were only taking up 5% and she was trying to say, hey, let's notch it up to 7%. But to say that businesses aren't contributing to the government when they're giving at least 40% of what they earn to the government right now, I mean, that's not hunky enough for her. And, of course, what about these band of marauders? She's saying, well, we protected them from a band of marauders. Look, if there was no government, there's no way thugs would possibly steal as much from a businessman as the government takes in taxes. You know, I would take my chances. You know, if the government were to say, hey, Peter, I got a deal for you. We are not going to tax you at all, and you're going to have to fend for yourself when it comes to police and fire protection. I would take that deal in a heartbeat. I could have an army. I can hire a private army to defend me. I could have my own fire truck on my property and full-time firemen for a lot less than I'm paying in taxes. I mean, it isn't even close to say that the government is protecting businesses from the marauders. The government is the marauders. They're the ones that are stealing. They're the ones that are looting. Who's going to protect us from the government? That's what I want to know, because obviously the courts aren't doing it. Anyway, let me take a break from the sound. I got some more other, but I want to go back to the phone. So next up is Joe calling from Montreal. We've got more Canadian calls coming in. Joe, welcome to the show.
Yeah, us Canadians are well informed, you know. We listen to you. Hey, listen, Peter. Why is it that the stocks have been, the gold or the precious metals have been taking a beating? I thought they, you know, with the announcement of Twist yesterday, they should have been booming. They should have been soaring. You know, like, what are we supposed to do? Are we supposed to jump in now with both feet and buy them, or is it?
You got to remember. Okay, nothing goes up in a straight line. Yeah, gold is taking a beating today, down about $50, $20 late yesterday, but you know, it's still at about $1,700 an ounce. I mean, gold is in a massive uptrend. That's not true for stocks. That's not true for a lot of other things. So nothing goes up in a straight line. I mean, so yeah, it's down. I mean, people are like, you know, you can't expect it to go up every single day. It's not going to happen. But I'm confident that the price is going to keep trending in an upward direction. Even if it has some downward moves along the way. You just have to expect that. And you can't, you know, lose confidence in gold if it doesn't go up every single day, because it can't do that. You know, especially when you have a lot of the leveraged speculators. I mean, there are probably a lot of hedge funds in there. They're getting margin calls. I mean, they're liquidating this market. People are having to come up with cash. They got to sell. And, hey, maybe there's just people that are too afraid to buy today. But, you know, I think that the dips are good. I think they're healthy. I think they're opportunities. Can gold go down more? Yeah, of course it can go down more. Maybe could it go down to $1,550? Or yeah, I could do it. I mean, does it mean it's going to do it for sure? No. I mean, it probably won't, but it might. But does it matter? No, it doesn't matter. I mean, it matters if you're buying call options that are expiring next month. Then it really matters. But you know, I'm not telling people to do that. I'm not telling people to try to bet on the timing, because no one knows for sure the timing. I'm pretty sure I know the direction, and so as long as we are not levered and we're not buying options, the timing doesn't matter. All that matters is the direction. Now, as far as the magnitude of the move, I'm not sure how big it's going to be, but I think it's going to be pretty big. But either way, you know, I think we make money. We just don't know how much, and a lot of it depends on what the governments do, what the central banks do.
So going forward, though, I mean, we're not going to see another 2008, though. I mean, because last time you told, like, well, even me, I believe that we were decoupling from the Dow Jones, you know. And now, you know, sometimes you seem to follow it. So, you know, like.
Yeah, I think we're going to have the decoupling. I mean, right now the world is still trying to maintain the coupled relationship. I mean, the emerging markets, countries like China, are still trying to sell products to Americans or Europeans rather than allow their own consumers to enjoy it. I mean, they want to move in that direction, but they're afraid to let their currency go up. I mean, you know, they shouldn't be afraid. They should embrace it. But, you know, there's so much nonsense out there among all the top economists. They know so little about economics that they're all making the same mistakes based on the same false paradigm. But I am not expecting a complete redo, a rerun of 2008 where the currencies implode, and gold collapses, and treasuries have a huge rally. They're already, I mean, how much can treasuries rally from where they are now? I mean, they're already so low. How could people be piling into treasuries now? I mean, of all the stupid things you could possibly do. So I just don't think we're going to get a complete rerun. I think it's going to look like 2008 for a while to create some fear so people act irrationally and do the wrong thing. But I don't think we're going to redo it completely. I think we're going to get the opposite, where people flee the dollar and flee treasuries, not embrace them. Anyway, hey, thanks for your call. We will be back with more of the show, so stick around. This is Peter Schiff at SchiffRadio.com.
The Peter Schiff Show. Since the Peter Schiff Show was last on the air, the national debt added another $7.89 million. Luckily, Peter's intelligence is growing twice as fast.
That's incredible.
Welcome back to your source of sanity in an insane world. It's the Peter Schiff Show.
We are back. This is Peter Schiff. Again, we are at the final segment of the show. Time really went by. Hey, we got a lot of people on hold. I doubt we'll get to everybody. I do want to play one quick sound clip, though, before I go. I'll just do one. Apparently, we got Ron Howard of Happy Days fame on CNBC joining the, hey, raise my taxes crowd. Hey, let's hear what Richie Cunningham has to say. Cut number 4.
I'm not averse to paying some taxes to try to help the country grow.
Paying
and help
more
the
taxes than you pay right now?
For me personally, I believe that it's silly. I'm with Warren Buffett on this one.
Okay, so Ron Howard wants to pay more taxes because he thinks it'll help the economy grow. Well, then why not give the government all your money? Let it really grow. The reality is sending private sector money to Washington doesn't grow the economy. It destroys the economy. The problem is too much money is going to Washington. That's the problem. Now, maybe if all the money went to reduce the deficit, it might, help a little bit to the extent that to be a smaller deficit. But the problem is when you send government more money, it doesn't reduce the deficit. They just spend it, and the deficit keeps growing. If we want to grow the economy, we have to keep the capital, keep the money in the hands of entrepreneurs so the economy can grow. Don't send it to Washington because that's going to make the economy shrink. It'll make the government grow. That's what taxes do. But growing the government doesn't grow the economy. It stops the economy from growing. Anyway, let me go to the phones. I'll squeeze in as many as I can. On hold is Drew calling from Michigan. Drew, welcome to the show.
Hey, Peter. How are you?
Good.
Hey, thank you for taking my call. My question has to do with the U.S. currency and if there's enough gold in the world to back that currency, or are we looking at a case where there just isn't and they'll probably never get to doing that anyhow, such that we're looking at this inflation coming down the road? And as that relates to my question is I'm in the real estate business, and I have the ability to borrow from various sources, including HUD, for 30 years or more at these low fixed interest rates, which I know is crazy why they're doing this, but I'm thinking maybe I can take advantage of it, lock in a huge cost of my capital at low rates for 30 years and buy some property. Would something like that seem to make sense to you?
Look, I've said before many times that the rates are really low, and locking them in makes a lot of sense. It just depends on what you buy in order to lock them in. I mean, And is it a good investment, or is it just a way to if you could do it with a very small amount of money down? See, that is the problem. And if you have to put down a lot of money, like my house that I own. I mean, I have had to put when you get talking about these jumbo, I levered it up, but I need to have at least a 30% down payment. So I know from a investment point of view that even if I wipe out my mortgage completely because there's hyperinflation, I would be better off if I was just renting and I took the 30% that I need to have down and I use that to buy a better inflation hedge than a house. But since I'm in the house anyway, that's why I'm obviously going to take that mortgage. I don't want to tie up all that money in the house. I'll tie up as little as I'm allowed to, and the rest I want to finance it over 30 years. And I'm about to try to refi again. I mean, I'm at 5%, so I think I'll be able to get down to at least 4.5. Maybe I can get down closer to 4. We'll see. But I definitely think you want to lock in these low rates because one of these days it's going to skyrocket. But I also think you want to delay your payments. I think the further into the future you make your payments, the less it's actually going to cost you in terms of real purchasing power.
Great. Well, that's very helpful. Thank you.
All right. Thanks for the call. Next up is John in Tampa, Florida. Hey, that's where we're having a debate. Where are the Republican debates tonight? Are they in Tampa or further south? Orlando. Okay, not too far. But, hey, I forgot to mention them. We'll be watching those tonight. And, of course, we had Gary Johnson on yesterday. It'll be good to see Gary on the stage. Hopefully they don't completely ignore him. Maybe they at least throw him one question. But Gary and Ron together, that means at least the limited government wing of the Republican Party is going to have a little bit more airtime.
Well said. And if all these government programs are so great, why are they all sold to me at the point of a gun?
Well, precisely, as I just said, I would opt out of all of it. I mean, for the amount of money I pay in taxes, hey, I could pay people to protect me, to put out the fires if there's a fire. Hell, I mean, it's and the thing is, what I say is true. The reason that the government has the money to do all those things is because of the businessmen and the entrepreneurs who create the businesses that create the tax revenue that makes it all possible. She's got to, bass backwards.
They don't even do their job. I mean, we've got some cave dwellers with box cutters take down 3 buildings in New York City, and we're spending trillions on our military, and nobody gets fired. And the firemen, how did Building 7 fall from a fire if we got such great fire protection?
Well, I don't know that you can blame that on the firemen. I think you can blame it on some strategic maneuvers where you have these airplanes full of jet fuel crashing into those buildings. I don't think that's the fault of the fire department. But I do agree with you that we are wasting way too much money and calling it national defense. I'm with Ron Paul. His platform is peace and prosperity. They go together. War and prosperity don't. So we got to get rid of the welfare and the warfare. Anyway, let me move right along to Peter calling from New York. Peter, welcome to the show.
Oh, yeah, how you doing? I just want to follow up that last person's call was wondering why gold went down. Just to give you my example, I've actually had gold GDX called away from me 2 or 3 weeks ago at $62 and $63. And today I just sold some 58 puts to hope to get it back. And I've actually sold some losers this morning, recognizing some losses, but I'm going to pair those off with my gains. But that's what's happening in the market is there's a lot of dumb money out there who's selling gold and buying crummier assets like, JP Moran and Citibank and so on and so forth.
Well, there's obviously a lot of people selling those stocks too. But yeah, in the short run, there's a lot of noise, and you just got to either just tune it out or try to use it to your advantage. But don't let it, discourage you or cause you to, cash in your chips on what I believe is a winning hand.
I'm adding my GDXs. I'm buying some more today. I still got some more cash, but I just want to keep the powder dry a little bit.
Yeah. All right. Well, good luck. I mean, you're a trader, and it sounds like you know what you're doing. And for most people, though, I think the best thing if you have a job, don't try to do what this guy's doing. It takes a lot of time and a lot of knowledge. Just buy the right assets and hang on to them, and just don't lever up, and therefore you don't have to worry about the margin calls. Anyway, hey, last caller, closer to home, Brian from Stamford. You're on. Hey, Brian, the show is ending. I'm sorry. I don't think we have time. Maybe you want to say hi.
Yeah, well, it was a good show.
Hey, Brian, call back tomorrow. I like to get the calls from Connecticut, my home state. Anyway, hey, that's it from today. We're going to probably have a lot of action later on this afternoon. I put up a new video blog yesterday if you want to check that out on the Operation Twist. But we'll be talking tomorrow about the markets and the Republican debates. Make sure to watch tonight. Anyway, this is Peter Schiff at SchiffRadio.com, the gold standard in talk radio.